for the past, 40 plus years, we've been in this environment of steadily declining interest rates, higher and higher equity valuations, more and more debt as a percentage of GDP. And that's been kind of this like nice coasting scenario. But as we enter this next period where we have maybe sideways interest rates, asset prices that therefore are maybe struggling to go up, deficits that are completely blowing out for demographics reasons, as well as the fact that that 40-year machine is kind of like out of juice now, we enter, I think, a more challenging time. And the analogy that I've often been drawing from, there's no perfect historical analog, but when I look back at the 1940s, it's the last time public debt as a percentage of GDP was this high. I look at it from both the UK angle and the United States angle and other countries. And it's very instructive for this period because, one, it shows how they tackle high debts environments. And some of those are kind of unpleasant, things like capital controls and things like, financial repression, that I think it's useful from, say, a Bitcoin perspective to understand these periods, to know how to navigate it and some of the tools that they're probably going to bring in their tool chest.
Bitcoin staged a classic range comeback on May 23rd as markets bought hopes that the United States had resolved the debt ceiling debacle. Data TradingView followed BTC USD as it headed toward $27,500 on Bitstamp overnight. Still stuck in a familiar trading corridor, the pair nonetheless showed signs of life as news hit that the Biden administration had potentially resolved the debt crisis. This turned out to be premature, but Bitcoin stayed higher on the day, as market participants hoped that bulls could follow through. Hello and welcome to Money Talks. In today's video, Lyn Alden shared with us her prediction for Bitcoin and crypto for 2023, and when we will see an all-time high again in Bitcoin.
I think a really good instructive example we see is with some developing countries today that have currency issues. So an example is Nigeria for a while now has kind of severed crypto exchanges from their banking system. So it's actually really hard to make it illegal. There's a lot of enforcement points. It's easy to disregard that. But the lowest hanging fruit that countries can have is just make it either hard or entirely cut off from banks being able to go to these exchange points. And then more recently, we saw Argentina kind of make similar moves where they're dealing with 100% inflation. And so they turn to try to limiting the outflows that are going into things like stable coins, Bitcoin, all these other assets. They want to stem the tide. And even before these types of actions, a lot of these countries have all sorts of restrictions on their citizens' abilities to get dollars. And again, sometimes it's on the individual level, but the easier place to do it is on the banking level, because even though some trickles in and out, it just kind of turns the fire hoses into garden hoses. It kind of slows down the leaks. And so it'd be kind of unprecedented in some ways to see it happen in developed countries, because, part of what makes the United States global reserve currency is our open capital markets and all that. But when we go back in history, when you look at, for example, the World War I, World War II environments, last time you had very inflationary environments, last time you had major war, last time you had very high sovereign debt levels. The United Kingdom at the time was the global reserve currency, and they had all sorts of draconian capital controls, securities controls, lending restrictions. That's another thing we see in Turkey recently, is that when they try to keep interest rates low, but they have inflation high, so what do? Then they try to restrict types of lending that people can do, so that you can't, for example, borrow Turkish lira and plow it into gold or Bitcoin or dollars or something like that. They try to make that harder to do. And I think it's important not to be asleep at the wheel for some of those risks that could materialize in 3, 5, 10 years as we go through some of these kind of macro transitions that are currently happening and then probably still ahead of us.
Popular traders skew-eyed various trend lines, including hourly and daily exponential moving averages, EMAs, for cues as to short-term moves. Successful bounce from weekly open reclaim into the bounds of 4 HEMAs and 1 DEMAs, part of a Twitter update stated. Looking forward, would expect real positioning to shift and show up today. Hold both EMA trends equal sign resolution towards $30K plus failure. Equal sign price pulls back towards 200 WMA again.
I think the path we've seen for a while now, ever since, say, autumn of last year, is you've had these two opposing forces. So on one hand, you have the Federal Reserve still trying to tighten policy. whereas the Treasury was actually offsetting some of that. They were actually pushing liquidity back into the market using their Treasury cash accounts. It's kind of like how if you were not allowed to borrow debt and you lost your income, how would you keep paying your expenses? Well, you'd probably draw down your savings and keep paying your expenses until you basically ran out of savings. And so the Treasury has cash that they hold at the Fed that they have kind of like, in their kind of like liquidity buffer. And so for the past 6+ months, they've been pretty aggressively drawing down that cash balance and putting it back into the market because they couldn't issue more debt. And of course, their tax revenues don't cover it. And so you had Federal Reserve QT, and then you kind of had like Treasury QE. And the challenge, everyone's focused on the debt ceiling right now. And of course, that's a hurdle they have to go through. Whereas I think the biggest question is what happens after the debt ceiling. Because when the Treasury is no longer offsetting some of the Federal Reserve policies, I think you're at a risk of a liquidity challenge. And then beyond that, you either see the Federal Reserve probably have to change some of their policies, maybe end quantitative tightening or take other actions, or you need to see the Treasury make unusual actions. Like, for example, they can issue a ton of T-bills to keep funding their large deficits, but that's the most expensive part of the curve right now. So that'd be kind of like an unusual move by the Treasury compared to how they would normally want to finance in this type of situation. And I think that a lot of that probably materializes in the second half of this year, or maybe if they push it out, maybe early next year.
Investigating the Binance BTC USD order book and monitoring resource material indicators suggested that markets had bought the rumor when it came to debt ceiling news. A subsequent tweet revealed that 2 of its proprietary trading tools had converged to deliver long signals. Confluence between the algos has historically been a very strong signal with a high probability of validating at the candle close.
So I think the biggest challenge is that people often think of like policymakers as one monolith, but you almost have like different factions that are operating. And I think one of the big challenges is that a lot of the inflation we've seen is from large monetized fiscal deficits. Right? So that was true in the 1940s and it's true now, whereas in the 70s, most of the inflation was coming from actually bank lending. And the Federal Reserve only has kind of a pretty small set of tools to deal with that. They can raise interest rates. They can do other things to kind of restrict how much bank lending is happening. And so you see, for example, when Jerome Powell talks about his inflation-fighting efforts, what he's mainly focuses on trying to get banks to make fewer loans. He's trying to restrict the availability of credit. And the challenge is that wasn't the heart of why inflation happened. That wasn't the source of new money creation this cycle. And it wasn't the source of what's happening, but it's the only lever that he really has control over. So that's actually something you see in those periods of financial repression or to more extreme extents, capital controls, but even just financial repression, because you have the public sector flooding the market with what is currently $2 trillion annualized deficits, pretty much, because you don't have asset prices going up and you still have those large expenditures. The problem is that as that goes into the market, the only thing that the Federal Reserve knows how to do is basically then try to control the private sector, the banking credit sector to shrink a little bit. And so you have that classic crowding out effect. And so I actually think that some of the stimulus you might see in the future, like let's say when they eventually run into a liquidity problem, they have to kind of inject liquidity back into the market. I don't think we'll see the types of like direct stuff we saw last time. I think there'll be a somewhat more like bifurcated, environment where they're trying to, on one hand, prevent money growth too much from, say, the banking system, while they still have large money growth from the public sector. And that's where you can get your risk of more of these capital controls coming into place. They could say, okay, we have, national security issues, so banks are now highly restricted from dealing with certain industries or sending money in certain directions. And that's always easier for them to manage than on the individual level.
So, what are your thoughts? Is $30,000 back on the cards? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.